Good afternoon, everybody. My name is Barry Herzog. I'm a tax partner at Kramer Levin. I'm joined by my tax partner, Pam Capps. And what we're going to talk about in the next half hour are certain tax-related provisions that were provided primarily in the CARES Act that was enacted last week and signed by President Trump. These tax provisions are intended primarily to help individuals and business, help them ameliorate the cost of the pandemic we're facing, and to a large extent by trying to put as much as possible cash into the pockets of both individuals and businesses. We're going to focus on the latter primarily. A lot of these provisions in the CARES Act, some of them are amending certain provisions that were enacted in connection with the 2017 tax reform, which we'll talk about. But before focusing on the CARES Act provision, Treasury has also taken certain steps to provide extensions of filing returns that Pam will talk about in just a sec. If you see on your screen, there's an opportunity to post Q&A questions. And if you type them in, if we have time, we'll try to answer them on the webinar, and otherwise we'll respond to you afterwards. So Pam, if you want to talk about the Treasury actions that it has taken.
Sure. Welcome, everyone. Through a series of notices, the IRS has extended both the filing and payment date for certain income taxes and estimated tax payments. And what they've extended are those income taxes and estimated tax payments and filings that were due on April 15th or are due on April 15th, 2020. And this is for everyone who has a due date on that date. So it includes individuals, trusts, estates, corporations, unincorporated businesses. It applies if that's your original due date or an extended due date for certain fiscal year taxpayers. But it's also important to understand what it does not apply to. It does not extend the time for filing or paying any other income or estimated tax due on any day other than April 15th. It does not extend payroll or excise taxes, although Barry will talk a bit about the payroll taxes in a minute. It also does not change any other deadlines under the code. People have been raising issues and have asked for extensions of certain deadlines, such as the time period for investing in opportunity zones, time period for completing 1031 exchanges, time for making certain elections. None of that has been addressed. It also does not extend the time for claiming any refunds if your refund claim is due on April 15th. The other thing to keep in mind is that these are federal extensions, and while most states have adopted some form of legislation or guidance to extend filing and payment dates in the various states, every state is different. So you would need to check the states in which you're filing to determine when and if those deadlines have been extended. I'm going to turn it back over to Barry now to discuss the deferrals of some of the payroll taxes and credits related to payroll taxes.
Okay, thanks, Pam. So one of the significant tax provisions in the Act has to do with the employer's ability to defer the payment of the employer's share of Social Security taxes. And what that means is when, with respect to every employee, there are certain Social Security taxes that have to be paid, FICA taxes. That comes out to, I think, 12.4%. Half of that is imposed on the employee and half on the employer. We're talking here about the employer's share and just the Social Security taxes, not the hospital insurance tax, which is an additional tax. So it's 6.2% that we're talking about here. What the Act says is that employers can defer the payment of all such employment taxes from through the end of the year. And those taxes are required to be paid over to the IRS, half at the end of 2021, half at the end of 2022. So if you have an employee, say, who's making, the maximum wages that on which Social Security taxes are imposed is about $137,000 each year. Since we're only talking about wages through the end of the year from now. So let's say that you have an employee who's making $100,000 to the end of the year. The potential deferral of taxes we're talking about is $6,200 for that employee. So that could be significant cash tax savings for a business. But again, those taxes ultimately do have to be paid, half at the end of 21, half at the end of 2022. Interesting question that has come up. Suppose an employer takes advantage of this. Normally, these employment taxes need to be paid over to the IRS on a regular basis, and if they're not, there's potential exposure for failure to do so. What happens if a company uses this money to run their business, things don't go well, and then ultimately the company cannot pay the tax? What happens in terms of that liability? Interesting question. So this provision could provide up to $6,200 approximately per employee for each employer in terms of current cash tax savings that ultimately have to be paid back to Treasury. So that's the deferral. There are also two credits that are available. They're called credits against employment taxes, but they're refundable credits. And as I'll describe, if an employer is not paying sufficient payroll taxes, they can get a refund from the IRS to cover in the amount of these credits. One of them is not under the CARES Act. One of them is under legislation that was enacted a couple weeks ago, the FFCRA, the Family First Coronavirus Response Act, where for certain employers, there's a mandated sick leave pay that is required, that if you have employees who are sick because of the pandemic, or they have family members that they have to take care of, or they have to stay home to take care of their children, that act requires the employer to pay a certain amount of wages to that employee. And together, the act also provides a credit to employers to cover those costs. So it's not really an out-of-pocket cost for employers. The Treasury is bearing that cost. The other credit that's available is under the CARES Act, and that we can refer to as a work retention credit, where again, Congress is trying to encourage employers to keep people on payroll, even if the business is suffering. And that credit is, the available amount of that credit is, for each eligible employee, you can get a credit for the payroll taxes with respect to wages paid to that employee that are called qualified wages, which I'll describe in a minute, but it's capped at $10,000 per employee, which means that potentially, and these are only for wages paid in 2020, for the remainder of 2020. So what we're really talking about is per employee that is eligible. If you have $10,000 and half of that is $5,000, the employment taxes, that same 6.2% tax that we referred to before, you can get a credit against that tax for $5,000 per employee, which would be about $300 per employee. And in order to be eligible for this credit, the employer has to meet one of two conditions. Either they have to be subject to a full or partial shutdown pursuant to a governmental order. For example, if in a certain state, your business is required to be shut down, that's one way to be eligible for the credit, either shut down completely or partially. And the other way is if your business is not required to be shut down, but year over year, you're suffering a decline of at least 50% in terms of gross receipts. And that test is done on a quarter by quarter basis. So you look at any quarter in 2020, compare that to the corresponding quarter in 2019. And if your gross receipts have been reduced by more than 50%, then you could be eligible for this credit. The number of employees that are affected and to whom you can get the credit for the payroll taxes depends upon if you're a large employer or a small employer. If you're a large employer, which means that your number of employees you had in 2019 exceeded 100, then in order to be eligible for the credit, it's only with respect to wages paid to employees that are no longer providing services. It's an open question whether it's not entirely clear if that employee is providing partial services, whether or not the employer can still get the credit with respect to that employee. For example, the classic case is employee has two functions, one of which there's a shutdown with respect to one of those functions. So the employee is now only, say, working part-time, half-time. Is that employee for a large employer eligible for the credit? With respect to small employers, those who employ less than 100 people based on 2019 numbers, for those employers, you can get the credit for all your employees. It doesn't matter to what extent they are continuing to work for you, as long as you're paying them. And so even if they're working full time, you could still get that credit. It's subject to the same cap I mentioned before, but it's much more favorable for small employers. Now, in terms of what constitutes a large employer versus a small employer, there the code refers to certain other sections of the code that refer to employers that are of multiple trades or businesses. So let's say that you have a business that is run by a single employer and it has only 80 employees. But if the owner of that business has another business that has another 30 employees, those two businesses together can be treated as a single employer and be treated as a large employer as a result. And so when thinking about the availability of this credit and whether you're a large employer or not, one has to take into account the applicable code provisions in terms of computing what is or is not a large employer. Another question that might come up on this is when we talk about whether or not you have a mandatory suspension of your business, which again, in order to qualify for the credit, either there has to be a governmental ordered suspension of your business or you have to suffer a significant decline in gross receipts. In terms of what's a government mandated suspension of your business, it's not entirely clear if you're like an indirect, if you're indirectly suffering as a result. For example, let's say you have a restaurant and the government orders a shutdown of the restaurant. It's clear that the employer who runs the restaurant is subject to a shutdown. But what if you're a supplier to that restaurant and there's no particular rule that says that you can no longer supply, but of course you have no one to supply to? Are you then subject to that same governmental shutdown and can apply for the credit on that basis? So those are some of the credit rules that in the Act. Again, there's the deferral that's eligible for all employers, and then there's this partial credit under the CARES Act for work retention, and then there's also the credit under the FFRCA. I'm now going to turn it over to Pam to talk about the NOL provisions in the CARES Act.
Thanks, Barry. So the CARES Act made several changes to the NOL provisions, including temporarily removing the changes that had been made in the 2017 Act. 2017 Tax Act made two significant changes to the NOL rules. One was to disallow any ability to carry back losses. And the second change that they made is to limit the ability to use NOLs to only 80% of taxable income. So if you had $100 of taxable income, you'd only be able to use $80 of NOL to reduce that income as compared to pre-2017 Act where you could have offset the full $100. So the CARES Act on a temporary basis reverses those changes and makes additional modifications. So the first thing that the CARES Act did was to create a 5-year carryback period for NOLs that are generated in 2018, 19, and 20. And, by carrying it back, having the ability to carry back losses from those years, there's two things. One, it is intended to allow companies to get cash back sooner. They don't have to wait for future years to get the benefit. If they create a loss in, let's say, 2020 and carry it back to a year in which they pay tax, they'll be able to get a refund and have additional cash flow sooner than they otherwise would have. The other thing that happened is because you can carry it back 5 years, there's the ability to carry it back to years in which the tax rate was 35% rather than the 21% current rate. So you're getting more benefit from those NOLs than you would have if the carryback was not available. It makes life a little bit complicated in that you wind up with 3 sets of rules regarding carrybacks and carry forwards. For NOLs that are generated on or before December of 2017, you have the historic 2-year carryback and a 20-year carry forward. For NOLs generated in years beginning after December of 17 and before January of 21, namely, calendar years 2018, 19, and 20 for calendar year taxpayers, there's a special 5-year carryback, and the carry forward is indefinite. And for NOLs generated in years beginning on or after January of 21, there again will be no carryback, but an unlimited carry forward. So it will matter as to when your losses were generated and when you're trying to carry those losses and use those losses. The second change was suspending the 80% limitation for 2018 to 2020. And again, the intention is just to free up more available cash and allow taxpayers to get refunds by not having those limits. A third thing that the new act did was to clarify certain calculations for years beginning in 2021. As a result of 2017 and changes made in 2017, there was definitely some confusion as to how you did certain NOL calculations because they were circular. You have a lot of deductions that are based on taxable income, and in determining which NOLs you're using first, which deductions count for taxable income for calculating certain deductions, how you incorporate the 80% was a little unclear. So they've clarified how that will work. Generally, you will give effect to pre-2018 NOLs first to offset up to 100% of taxable income. Then you'll apply your 80% limit, but without giving effect to deductions for qualified business income and GILTI deductions. Obviously, this becomes complex, but they have made an effort to clarify how that will be done. They've also, another change they made was a technical correction. When they made the changes in 2017, they had made the changes apply to tax years ending after December 31, 17, where the intention had been to tax years beginning after 1/1/18, so that for taxpayers with a straddle year, a fiscal year other than calendar year end, this will help them and allow them to carry back, get the benefit of the 2-year carryback for their year that ended in 18. An additional change that was made was just clarifying how NOLs will interact with the 965 transition tax. This was a tax that was imposed as a result of in 2017 on certain untaxed earnings of foreign corporations. The rules are sort of technical, but they have provided taxpayers with alternatives as to how to interact those two. As noted before, which states are widely vary in terms of how they calculate NOLs and whether they automatically follow federal law changes or don't. So if you're in a position where you're generating NOLs during this 2018, 2019, 2020 period for federal purposes, you'll also have to take note of how the various states in which you operate treat those NOLs, because it may or may not be the same as federal. And with that, I'm going to turn it back over to Barry to talk about changes to the limitations on interest expense.
Thanks, Pam. So as part of the 2017 tax reform, one of the provisions that Congress enacted was what we refer to as 163J limitations, which are limitations on the ability to deduct excess or net interest expense. So basically the way those rules work post 2017 tax reform is that a taxpayer can only deduct their net interest expense to the extent of 30% of adjusted taxable income. So if you have adjusted taxable income, which I'll describe in a second, of 100, and you have $50 of interest expense, you would only be able to deduct $30 of that interest, and the remaining $20 would carry over, and be treated as interest expense in the following year. Adjusted taxable income is basically until the end of 2022. It's basically somewhat akin to EBITDA, and after 22, it's going to be more akin to EBIT. So that this limitation imposes, for a lot of companies, the inability to fully deduct their interest expense. Obviously, in a period of decline of taxable income, for example, like as a result of the pandemic, if your adjusted taxable income is declining, the ability to deduct your interest expense is going to go down, which should be in a case of, it should be the opposite. It should be that you should be able to take full bit more advantage of your interest deductions in a period of economic decline. So to help ameliorate this, Congress did two things in the CARES Act. First, they said that for 2019 and 2020, the limitation is not 30% of adjusted taxable income, but they increased the limitation from 30% to 50%. So in my example before, if your adjusted taxable income is 100 and you have $50 of interest expense, for 2019 and 2020, be able to deduct the full interest expense, not just 30 of the 50. The other thing that Congress did was said that with respect to 2020, when your adjusted taxable income may be declining as a result of the pandemic, you can compute your limitation by reference to your 2019 adjusted taxable income. So taking my example, if you have a taxpayer that in 2019 had adjusted taxable income of 100, $50 of interest expense. In 2020, that same $50 of interest expense, but adjusted taxable income drops from 100 to 80, that taxpayer would still be able to deduct the full 50 because the limitation is based by reference to 2019 adjusted taxable income rather than 2020. Those are the basic rules that Congress enacted. Special rules were enacted for partnerships that we're not going to go into. Just one interesting thing to note about this provision is, as well as the NOL provision, is that in the context of M&A transactions, if you're a company that is either been acquired or sold during this period between, say, 2019 and 2020, sometimes your M&A, your purchase agreements may provide that the seller is entitled to certain refunds for pre-closing periods. And it's worthwhile checking these agreements to see whether or not, if you are on the sell side, whether or not you're eligible to amend your returns and potentially get dollars back, potentially from the purchaser. And if you're on the buy side, to see if you do carry back to pre-close periods, to see who's the beneficiary of that refund, whether it's a carryback of a loss or amending because of these 163J change limitations. I'm going to turn it over back to Pam to talk about qualified improvement property.
So qualified improvement property, the CARES Act fixes a technical glitch from the 2017 Act, which seemingly inadvertently made qualified improvement property subject to 39-year depreciation. The intention from all the legislative history and prior law seemed to indicate it should have been 15 years. But there was a technical glitch which has not been corrected until the CARES Act. Qualified improvement property is generally any improvement made by a taxpayer to a non-residential building interior that's placed in service after the initial placed in service date of the building in general. It does not include enlargement or structural framework. And what the Act does is to correct this and make it 15-year property. The benefit of being 15-year property is that such improvements can then qualify for the bonus depreciation, so they could be written off 100% in the first year. They made this correction effective as of the 17 Act and effective date of December 22nd, 2017, which means that if you placed qualified improvement property in service either the last week of 2017 or if you placed any such property in service in 2018, it might be possible to either amend your return or file a change in method of accounting and get a tax benefit for those periods. One thing to note is that the additional depreciation may not apply with respect to certain real estate businesses to the extent that they have elected to not have the interest limitations that Barry just discussed apply to their business. There's an option for real estate businesses to not have those as long as they use the alternative depreciation system. Here, the alternative depreciation for this improvement property would be 20 years. And so therefore you're outside of the bonus depreciation period. I'm going to turn it back over to Barry to wrap things up here.
Thanks, ma'am. So just one more thing about the Act and then a little closure. One is that the Act also provides, obviously, much of the Act is not tax related, is talking about assistance in various forms of loans or other types of assistance to companies. And one of those forms of assistance is loans to small businesses. There's a specific provision in the Act that says that those loans can be forgiven under certain circumstances. And if those loans are forgiven, there's an explicit provision in the Act that says that that forgiveness does not give rise to taxable income. In other words, it's excludable from income, which is a very helpful provision. There are other parts of the Act, though. That's the only place in the Act that I'm aware of where it specifically mentions how a forgiveness is treated. But there are other forms of assistance in the Act where also there could be, that assistance might also be ultimately forgiven by Treasury that's providing the assistance. And the question is whether or not that forgiveness is taxable or not taxable, or is it excluded like the small business loans, which is, I think a question worth exploring and would obviously depend upon the facts and circumstances, but something that we just wanted to mention. So thank you very much for joining us today. I think we're hitting our limit. in terms of time. Kramer Levin is going to be hosting additional webinars on certain provisions of the CARES Act next week, so you should keep an eye out on your emails for those. And thank you very much for your time.